Welcome to our deep dive into one of the most dramatic events in cryptocurrency history, the LUNA Terra Crash. In this video, we'll explore how a revolutionary project went from promising stability and high returns to a catastrophic collapse, leaving investors stunned and the crypto world forever changed. Imagine waking up one morning, checking your crypto portfolio, and discovering that the digital asset you trusted with your future is suddenly worthless. This is the story of the LUNA Terra Crash, a dramatic and catastrophic collapse that shook the cryptocurrency world to its core. Today, we will take an in-depth look at how a project that once promised stability and high returns went from being the darling of investors to a cautionary tale of hubris and fragility. Grab a seat and prepare for a journey through one of the most significant events in crypto history. The story begins with Terra, a blockchain project that set out to revolutionize traditional finance. Terra was not just another cryptocurrency, it was a vision of a decentralized financial future. The project was built around two key components: LUNA, the native token, and UST, an algorithmic stablecoin designed to always hold a value of $1. Unlike conventional stablecoins that are backed by tangible assets like dollars or gold, UST relied on an algorithmic mechanism involving LUNA to maintain its peg. This innovative model was both its greatest strength and its most dangerous weakness. Terra's promise was simple yet ambitious. The idea was to create an ecosystem where UST would serve as a stable digital currency for everyday transactions, while LUNA would act as a buffer to absorb market fluctuations. When UST traded above $1, the system allowed users to mint new LUNA by exchanging UST, theoretically bringing the price back down. Conversely, if UST fell below $1, users could exchange LUNA for UST, which should have pushed the value back up. This balancing act was designed to maintain stability without needing a reserve of physical assets. In theory, it was a brilliant piece of financial engineering that attracted millions of investors and earned accolades for its innovation. Investors were especially drawn to Terra because of the high yields promised by the Anchor protocol, a part of the ecosystem that offered returns as high as 20% on USD deposits. In a market hungry for alternatives to traditional banking products, these returns seemed almost too good to pass up. People from all walks of life began to pour their money into Terra, believing that they had discovered a safe haven in an otherwise volatile crypto landscape. The enthusiasm was palpable, and soon Terra became synonymous with the promise of quick and substantial profits. However, the very mechanism that made Terra innovative also set the stage for its downfall. The stability of UST depended entirely on market confidence and the flawless execution of the algorithm. As long as investors believed that UST would remain pegged to $1, the system worked seamlessly. But this delicate balance was built on an illusion, a system that required constant trust in an algorithm rather than the backing of real-world assets. Over time, cracks began to form in this seemingly robust framework. In early May 2022, what appeared to be a minor deviation from the peg sparked a catastrophic chain reaction. UST began to trade at around 97 US cents instead of its promised $1. For many, this slight dip was an early warning sign. In a perfectly balanced system, a minor fluctuation might be quickly corrected by the algorithm. However, in the case of Terra, the drop in UST's value triggered mass sell-offs. Large investors, noticing the deviation, rushed to exit their positions, and the situation quickly escalated from a small hiccup to a full-blown crisis. As UST continued to fall below $1, the algorithm kicked into overdrive, creating more LUNA in an attempt to restore the balance. Instead of stabilizing the market, this led to a hyperinflationary spiral. With an ever-increasing supply of LUNA flooding the market, its price plummeted at an unprecedented rate. In just a matter of days, LUNA, which had once traded for as much as $80 per token, was reduced to a few cents. The rapid devaluation left investors reeling, as billions of dollars in wealth evaporated almost overnight. Amid the chaos, the figurehead of Terra, Do Kwon, emerged as both a symbol of hope and a target for blame. Initially, Do Kwon remained calm, issuing reassurances and promising innovative solutions to save the system. His confidence, however, did little to stem the tide of panic that was sweeping through the market. As the crisis deepened, it became painfully clear that the measures proposed were insufficient to salvage the collapsing ecosystem. The trust that had once underpinned Terra's entire foundation was gone, and with it, the possibility of recovery. Regulatory bodies and government agencies quickly took notice of the unfolding disaster. Cryptocurrency exchanges around the world began to suspend trading of LUNA, and investigations were launched to determine what had gone wrong. Investors were left with no choice but to watch in horror as their hard-earned money disappeared. The fallout from the Terra crash was not limited to individual losses. It sent shockwaves throughout the entire crypto community and reignited debates about the risks associated with algorithmic stablecoins. Beyond the technical mechanics of the collapse, the human impact of the Terra crash cannot be overstated. For many, this event was not just a financial setback, it was a personal tragedy. Stories began to surface of everyday investors, retirees, and even small business owners who had put their faith and savings into Terra's promise of a better future. Their dreams were shattered in an instant, serving as a stark reminder that behind every digital token lies the very real possibility of risk and loss. So, what exactly went wrong with Terra? To understand the collapse, we need to delve deeper into the mechanics of its algorithmic stablecoin. UST was designed to be a self-correcting system, relying on market participants to maintain its peg. However, this system was predicated on the assumption that investors would remain rational and that the market would always have sufficient liquidity to absorb fluctuations. Once panic set in, these assumptions no longer held true. The rapid creation of LUNA in response to falling UST prices only exacerbated the problem, leading to an uncontrollable feedback loop that drove prices down even further. Critics of Terra had long warned that an algorithmic stablecoin without tangible backing was inherently unstable. The system required a level of trust that could vanish as quickly as it was built. Unfortunately, the Terra crash proved these warnings to be all too valid. The entire model, which had seemed so promising in theory, crumbled under the weight of market sentiment and the harsh realities of investor behavior during times of crisis. The collapse of Terra has left the crypto world reeling and has sparked important discussions about the future of digital finance. One of the key lessons from this debacle is the critical importance of transparency and robust risk management. Investors must be cautious when considering projects that promise extraordinary returns, especially when those returns are tied to systems that lack a solid foundation. Diversification remains one of the best strategies for mitigating risk. Placing all your trust, and your money, in one project can lead to devastating losses when things go wrong. Another takeaway from the Terra crash is the need for clearer regulatory frameworks in the cryptocurrency space. While innovation is essential for progress, it must be balanced with accountability and investor protection. The Terra incident has prompted calls from regulators around the world for more stringent oversight of digital assets and the mechanisms that underpin them. By ensuring that projects adhere to high standards of transparency and risk management, regulators hope to prevent similar crises from occurring in the future. The story of the LUNA Terra crash is a powerful reminder of the double-edged nature of innovation. On one hand, projects like Terra represent the cutting edge of financial technology, pushing the boundaries of what is possible and opening up new avenues for investment and growth. On the other hand, they also highlight the inherent risks of venturing into uncharted territory without sufficient safeguards. The lessons learned from Terra are not meant to discourage innovation but rather to encourage a more thoughtful and cautious approach to the development and adoption of new financial technologies. As the crypto market continues to evolve, many are asking, will we see another collapse like Terra in the future? The answer is not straightforward. While the industry is undoubtedly more aware of the risks associated with algorithmic stablecoins, there is still a strong appetite for high returns and groundbreaking technology. The challenge for developers and regulators alike will be to strike a balance between fostering innovation and ensuring stability. Only time will tell whether the lessons of Terra will lead to a more secure and resilient crypto ecosystem or if the cycle of boom and bust will continue. In the aftermath of the crash, the crypto community has been forced to confront some hard truths about the nature of trust, risk, and the future of decentralized finance. Many investors are now more cautious, and there is a growing consensus that no system is infallible. The Terra crash has served as a wake-up call, reminding everyone that even the most promising projects can fail when the underlying assumptions prove to be unsound. Looking ahead, the road to recovery for the cryptocurrency market will likely be long and challenging. Developers are already working on new models for stablecoins that incorporate additional safeguards, such as collateral backing and improved algorithmic controls. These innovations aim to create a more secure foundation for digital currencies, one that can withstand the pressures of market volatility and investor panic. While the shadow of Terra still looms large, it may also serve as a catalyst for positive change in the industry. In conclusion, the LUNA Terra crash is a stark reminder of the perils of unchecked innovation and the critical importance of sound financial principles. It is a story of ambition, excitement, and ultimately, tragedy, a narrative that underscores the need for caution in the fast-paced world of cryptocurrencies. For investors, the lesson is clear: Do your research, diversify your investments, and never place blind trust in a system that has not been thoroughly tested in the real world. If you found this exploration of the Terra Crash insightful, take a moment to reflect on how this event might influence your approach to investing in the future. The crypto landscape is constantly evolving, and staying informed is your best defense against unexpected downturns. Remember, every new technological breakthrough comes with its own set of risks, and it is up to us as investors to balance our optimism with a healthy dose of skepticism. Thank you for joining me on this journey through one of the most significant events in crypto history. I hope that by understanding the rise and fall of Terra, you can better navigate the complex world of digital finance and make more informed decisions in your own investment journey. Stay curious, stay cautious, and as always, invest wisely. This is more than just a story of a collapse, it is a lesson for the entire industry, a reminder that behind every promise of stability lies the potential for dramatic change. Let the saga of Terra guide you as you explore the ever-evolving frontier of cryptocurrency. Thank you for watching this deep dive into the LUNA Terra Crash. If you enjoyed the video and want to see more in-depth analysis and crypto stories, please hit the like button, subscribe to our channel, and leave a comment below. Stay tuned for more insightful content and remember, invest wisely.